Yes, sir. Your voice is audible, sir.
Okay. On behalf of the managing committee members of the Vellore, Pondicherry, and the Salem branch, I cordially invite all the members and non-members who are participating for today's webinar. As you are aware, we are on the last spell of our month-long GST webinar program, and I hope that the members enjoyed the webinar so far. We are also receiving positive responses from members of this seminar then and there. Today's topic of webinar, the exemption bar zero-rated supply, is also a challenging section in our practical situation, and we are eagerly waiting for our speaker to overcome the above. With this, now I invite our Secretary, C. Praveen Kumar, to introduce the speaker. Thank you.
Good evening, everyone. I have been given the pleasant task of introducing the speaker for today's session, CAB Deepak Kumar Jain. Mr. Deepak is a fellow member of Institute of Chartered Accountants of India and associate member of Company Secretaries of Institute of Company Secretaries of India, and he is also holding a bachelor degree on law. Mr. Deepak has more than 19 years of experience on indirect taxes, including 9 years of work experience with Big Four accounting firms. He is the founder of Accolade Advisors Private Limited and of the domain app indiagst.com, which provides professional advisory, compliance, and litigation support services to Indian as well as multinational companies on excise, customs, service tax, VAT, entry tax, and FTP and SEC matters. Mr. Deepak has authored a book on anti-dumping, anti-subsidy, and safeguard measures published by Institute of Chartered Accountants of India in March 2007, a book on GST published by Bangalore Chamber of Industry and Commerce in Jan 2010. He has also co-authored a book on service tax in a nutshell published by Federation of Karnataka Chamber of Commerce and Industry. Mr. Deepak is also a part of expert committee on indirect taxes of trade associations and bodies including BCIC, FK, CCI, and KSCAA. With these few words, I introduce our speaker for today's session. Welcome, sir. Welcome on behalf of the Vellore, Pondicherry, and Salem branch of SIRC. Thank you.
Thank you so much, Praveen.
Thank you, sir.
So, should I begin, Praveen?
Yes, sir. You can start with the session, sir.
Wonderful, yeah. So, good evening. Let me before I begin, let me thank the Salem branch, Pondicherry branch, and Vellore branch, correspondingly Ms. Parkavi representing Salem branch, Ms. Kirutika representing Pondicherry branch, and Mr. Sundarvardhan from Vellore branch. Right. So, I'm sure the three branches, it's really wonderful that all the three branches have kind of joined hands and from a knowledge sharing session perspective, come out with a wonderful GST web series. I thank Praveen to have kind of given an introduction. I'm sure the length of his introduction was probably more than the contents which I have to share for this today's session here. So I hope this 2 hours which we have, I'm able to kind of give justice to the topic. The topic allocated is on GST exemptions and zero-rated supply. Given that it is through webinar, I will definitely be as slow and try and kind of moderate the session accordingly. At the end of the session, I hope that anything and everything connected with GST exemptions and zero-rated, I should be able to kind of hopefully share. So what I will do is I will, for the benefit of all, I'll mute everyone. And if anyone has any questions to ask, they could kind of route it through Ms. Kirutika, so that she can then kind of pass it on to me, and I will be happy to kind of address. So that will ensure that we are able to kind of hear the speaker, and at the same time be able to kind of resolve any questions, any clarifications which you may have. Is this okay, Kirutika?
Yes, sir. We can even do the queries in chat box also.
Yeah, so because once I share the screen, I'm not sure whether I would be able to see the chat box. I may, while I'll try and kind of do that.
Chat box, we can take up at the end of the session, sir. No problem.
Yeah, wonderful. So while I will try and kind of do that, in the event I miss, I will need your help to kind of raise those questions. So what I would do now is share my screen so that the pointers which I have done for today are visible to all.
Okay, sir.
Is this visible, Kirutika?
Yes, sir. Yes, please, sir.
Yeah, and is my voice audible?
Your voice is somewhat low, sir. If it
Low? Yeah.
volume is okay, sir.
Yeah, what I'll do is I'll increase the speaker volume just to see if this helps. One moment. Yeah, is this better?
Yes, sir. Now it's okay, sir.
Wonderful. Yeah. Now, I think we have had series of topics which speakers have kind of addressed, and I'm sure I'm the sixth in this round. While we have understood the meaning of supply, race of supply, time of supply, so on and so forth, the today's topic is on GST exemptions and zero-rated supply. Definitely, while we may have, while all topics are relevant, the differentiating factor with respect to exemptions is that if you were to kind of claim an exemption or treat a particular transaction as zero rated when it is not so, it could kind of have a significant tax implication. And therefore, it is important for us to kind of understand and probably comprehend the scope of where exemptions are kind of available, and then to avail them and ensure that we don't have any non-compliances connected with that. So how I have spread my discussion for this 2 hours is largely to kind of understand first the different types of supply, that is the exempted supply and non-taxable supplies, look at how the definitions are, and then look at to kind of ensure that we have kind of covered all. I have selected a few issues and practical kind of scenarios which will kind of, if we were to kind of discuss them, I believe that it will kind of help us to probably fully understand and appreciate the entire topic. So during this session, as I kind of keep speaking, if you have any questions, wherever I'm required to kind of answer at that moment, I would request, as I said, to Kirutika to probably have those questions raised then and there so that I can address them. Alternatively, at the end of the session, we will have sufficient time to hopefully address all the questions. Right, with this, I proceed with the slides which I have prepared for the benefit of the audience. Now, definitely, I mean, if we were to kind of break the, if supply is one kind of whole, and if we were to break the supply into various components, this is what we have. One is taxable supply of goods or services, which is what the levy of GST is on. And transactions which are not taxable are probably classified into 3 buckets. One is exempt supply of goods and services. The second is non-taxable supply of goods and services. And third category, which has been interestingly introduced into the GST law, is something which is neither goods, neither services, while they may customarily be regarded as such. So if taxable supply is something which is sacrosanct and something which is identifiable and non-disputable, the area outside the taxable zone is therefore classified into these three segments. So what fills into exempt, what fills into non-taxable, and what fills into supply which is neither goods or services is something which we will discuss in the ensuing slides. First, let's discuss or understand what is the meaning of exempt supply. Now, exempt supply as it has been defined largely are into 3 buckets here again. One, which is something which will attract nil rate of tax. So government will issue a notification specifying a particular type of goods or services and specify that these goods or services will attract nil rate of tax. So if a transaction of supply attracts nil rate of tax in terms of the notification issued as such, the transaction is an exempt supply. Similarly, government has the power under section 11 of the GST law, which is CGST law, particular state GST law or UT GST law. And UT GST law largely borrows it from the CGST law that way. So the section 11 of the CGST law plus section 6 of the IGST law, government has the power to exempt a particular transaction of supply of goods or services. And if they have issued a notification exempting, then that exemption, whether it is in whole or in part, will also be to the extent it is exempted become or get regarded as an exempt supply. The definition of exempt supply under the GST law also includes non-taxable supply, and non-taxable supply has been defined, and we will discuss that separately. So if I were to summarize, exempt supply are into three buckets. One, which will attract nil rate of tax. Second, which is exempted by virtue of a notification, either wholly or partly. And third is something which is a non-taxable supply. Now here are certain illustrations where I have kind of bucketed them in terms of, I'm sure the listeners here would already be aware of this bucket, but in the interest of ensuring that there is completeness, I have kind of listed down in terms of an illustration. So notification number 1 and 2 in the rates notification for CGST law. Notification number 1 is basically something which specifies a particular rate for specified goods. Notification number 2 is an exemption. It's a jumbo notification listing out various goods to which the rate of tax is nil. So notification number 2, we can kind of consider that that's those items which are listed in notification number 2 are since they attract nil rate of tax, are exempt supply of goods. Similarly, for services, we have notification number 12, where specified list of services have been identified where government has said that they will attract nil rate of tax. And as regards exemption notifications, anything which is not specified in these notifications, government has the power under section 11 to issue notifications. So notification number I have kind of illustrated notification number 7 and 30 as ones which are issued under the CGST law and IGST law as such. Now, if you were to see, look at the power, right? I have kind of tabulated this. So the central government and the state government necessarily can issue this notification only based on the recommendation of the council. On what? On taxable goods. So they are already taxable. So on taxable goods and services of any specified description, if it is considered to be necessary in public interest, then by notification under section 11 or section 6, or by special order under subsection 2 and 6 or 2 of subsection section 6 or section 11 accordingly, exempt generally in the case of notification, it could be absolute exemption or it could be subject to certain conditions where the whole or part of the tax is exempted as such. But wherever it is under a special order, the special order comes in special circumstances, and therefore the exemption there is from the whole of tax thereon. So section 11, section 6 draw the power from the recommendation of the council, where the state and the center can issue notifications as such. So that covers the understanding of what is an exempt supply. So we saw, if I can summarize again, an exempt supply is something which attracts nil rate of tax, or which is by virtue of a notification under 11 or 6 exempted as such, and includes non-taxable supply. Now, what is non-taxable supply? Non-taxable supply again has been defined under the GST law as a supply, here again, of goods or services which is not leviable to tax. So transaction which is not leviable to tax is a non-taxable supply. Right? Now, let me kind of illustrate two scenarios. We have the section 9(1), right, which basically, if you were to see, there the levy is on specified supplies except supply of alcohol for human consumption. And similarly, section 9(2), where the levy on petroleum products can be done so with effect from a date to be notified. So as today, they have not been notified, and as such, as today, they are non-taxable supplies because they are not leviable to tax under this particular act. Now, in fact, transactions where which lack consideration, right? So if you see the levy section, levy largely will say a supply which is for a consideration is leviable to tax. So a supply which lacks consideration, is it a non-taxable supply? Is an ambiguity which basically is present in the GST law. I have kind of in the ensuing slides clarified that position. Maybe, that's my view. I'm sure as that particular topic kind of comes in, I'll probably address them. But as from an understanding perspective, non-taxable supply, as the definition reads, anything which is a supply of goods or services not leviable to tax. So there should be a supply of what? Goods or services. Is it leviable to tax? Then taxable. Not leviable to tax? Non-taxable supply. So that's how we can probably bifurcate and understand and give an understanding to the term non-taxable supply. Right. Moving on, we also saw that the bucket of transaction which is other than taxable, one of the bucket is transactions. One moment. So transactions which have been bucketed as neither goods or services. So government in the third schedule has identified certain transactions of supplies, which could be of goods or services, which have been categorized by the government as they are neither supply of goods or services for the purposes of the GST Act. So a transaction which is neither supply of goods or services, therefore gets into the third category. And from a listing, if you see 1, 2, 3 to 8, so these are the items which have been specified in Schedule 3. Services by an employee to employer, whatever employment services which we have, has been considered as neither goods nor services, right? One may note the way in which the statute is worded. Statute is worded only services of employee to employer and not something which is converse. That means if the employer were to render services to the employee, those services would be taxable. Only services of an employee in the course of his employment to the employer have been excluded as neither supply of goods nor services. So on and so forth are certain other specified transactions. Now the effect of a transaction which is neither supply of goods or services, what is the impact? When we calculate the reversal, because it is, and let me kind of go back to the definition of exempt supply. So exempt supply is something which includes non-taxable, but it does not include supply of services or goods which are neither, which is neither supply of goods, neither supply of services. So therefore the requirement under section 16 and 17 with respect to reversals may not be applicable to such transactions, though they need not get into the computation for reversal of ITC. I hope whatever I am conveying is understood in the same kind of sense here, and I would request Kritika, wherever possible, to kind of pause or clarify, or wherever I have to kind of do that, she may kind of make me kind of, or help me kind of do that, yeah, so that the audience here gets benefited of the entire kind of discussion. I move on. So what are the, so there are certain questions which may be related to the topic, and I mean, this is something which I have kind of raised it myself, so that we are able to kind of comprehend the understanding in terms of the discussion becomes more complete than otherwise. Yeah. So I had raised this issue with respect to supply of sample. A supply of sample is something which is a supply which lacks consideration. So reading the meaning of exempt supply or non-taxable supply. Non-taxable supply is something which is not leviable. What is leviable to GST is something which is a transaction of supply of goods or services having consideration. So few, I mean, from an interpretation perspective, few experts are of the view that the supply of samples which lack consideration ought to be regarded as non-taxable supply. In my view, it is a supply because it is at zero value. From a rate perspective, had there been a value, appropriate GST would have been paid. But because of the lack of consideration, transaction on this, the appropriate GST is zero. It is not that it is non-taxable. It is not leviable from a tax perspective is understandable. But yes, I mean, from a levy perspective, non-leviable, I mean, leviable, these goods are per se, had there been consideration, they were leviable to duty. But the transaction per se, because of lacking consideration, is not subject to duty. So I would probably be able to comprehend and say that if the transaction generally was not leviable, then yes, it's a non-taxable supply. But in this case, it is a supply which is taxable, but GST is not payable because the consideration is absent in this case. That way. And if we were to look at, I mean, if we were to see the reversal requirement under the ITC provisions, the fact that I'm supplying sample, there is a requirement to reverse ITC. Had the transaction been a non-taxable supply, I mean, per se, the need for specific inclusion was not there. So whether we regard this as a non-taxable supply or otherwise, from a exchequer's perspective, consequent to a specific provision in the GST law requiring the SSC to reverse the appropriate credit, the discussion whether it is a non-taxable supply or otherwise loses its significance. But from a transactional perspective, it is a taxable supply, lacking consideration, so ought to be kind of considered as such. So that's my personal view here. The other related question is, whenever there is an exemption, is it necessary for the supplier to probably, is it necessary for him to kind of avail the exemption, or is it an optional in terms of where he can kind of consider that to be liable to tax and charge tax and collect tax? Now, in the pre-GST regime, the notification had to kind of specify whether it is mandatory or otherwise. In the GST regime, the section 11, the explanation to section 11 explicitly provides that wherever there is an exemption provided in respect of goods or services, the supplier will have to kind of, he's not entitled to collect taxes thereon. So the intention of the government is, if there is an exemption, then that is passed on to the chain without kind of considering that as an option to the supplier. But if we were to read the words, what do you say, incomplete, I mean, if we were to see, I mean, let me, for the benefit of the audience here, let me kind of read that fully, and then we'll kind of see the possible different interpretations which can kind of come in. So what the explanation to section 11 states that where an exemption in respect of any goods or services or both from the whole or part of the tax leviable thereon has been granted absolutely. That means to say, if it is not absolute, then is there an option for the supplier to kind of charge tax, is something which is debatable. Now, looking at the intent of the notification, it very clearly says that wherever there is a clear exemption provided, now the term absolute is without, I mean, from without kind of conditions, whether it is in whole or in part, where the exemption is absolute, it is important that from the government's intention perspective, that this benefit be passed on, and the option to kind of charge tax or levy tax on that transaction ought not to kind of arise. So it may be appropriate here that wherever there are exemptions, it is very, very important that the benefit of the exemption is passed on to the consumer. And in terms of the registration, so a supplier who provides exempt goods or services, is he required to kind of obtain registration? Now, wherever the supplier is only providing exempt goods or services, section very specifically says the need for registration is not there. Section 23 has a specific mention where my services which I'm providing of goods or services are exempt, then I as a supplier need not kind of obtain registration. But wherever I supply both taxable and exempted, the calculation of the turnover will include the value of exempt turnover to compute the threshold requiring me to kind of seek registration or not. So if my exempt turnover and taxable turnover both put together cross the threshold requiring me to kind of take registration, then in terms of section 22, the supplier will have to kind of obtain registration. Now, whatever slides which we have kind of discussed, if we were to kind of look at what have we discussed, we have looked at the meaning of exempt supply, non-taxable supply, and a supply which is neither goods nor services. Right? So that kind of covers the understanding of the meaning of the first section, which is exempt supply transactions. Now let's move on to the understanding or the meaning of zero-rated supplies. Now, as the term suggests as such, zero-rated supplies are supplies. I mean, if we were to see section 16.1, it specifically categorizes two types of transactions as zero-rated. One is export of goods and obligor services. Second is supply of goods and obligor services to an SEZ developer or an SEZ unit. So if I export goods or if I supply to an SEZ unit, I am regarded, I mean, that transaction is regarded as zero rated. And section 16 does not exempt the supply. It basically says that the payment of tax need not be made for such transactions. So if we were to, see the way in which the law is worded, it is a taxable supply and the rate 0, that is zero rated, has been applied to those transactions in specified circumstances. So there is a distinction between zero rated and transactions which attract nil rate. A transaction which attracts nil rate is an exempt supply. A transaction which is zero rated is a taxable supply. Right? Now, what is the intent of the government to treat zero rated supplies as such? Now, if I'm an exporter of goods or services or a supplier to SEZ, which in turn export goods or services, the intent of the government is to nullify, basically nullify the incidence of taxes on such goods which are exported or services which are exported. Now, what you export is only the value of goods or services and not taxes thereon. So if the output tax is zero rated and the input taxes, which are basically tax paid on input services or capital goods, are allowed, the exporter, if he's not able to utilize those input taxes, he's allowed refund in terms of section 54. Right? So the objective and conditions of zero rating, maybe I have kind of listed out in this slide, which will help us to kind of see that the intention of the government is to promote exports and ensure that the goods or services which are exported do not have the incidences of taxes either on the input front or the output front. The section 54 read with section 54(8) unfortunately does not allow refund of tax paid on capital goods. Right? So if my taxes on output are zero rated, that is, I don't pay tax when I export them in terms of goods or services, and if I don't have any domestic liability and all my purchases have input taxes, there will be unutilized credit. Right? So unutilized credit may be for input services or capital goods. What happens to those unutilized input tax credits? Section 54 allows refund of input tax, input and input services, but not for capital goods. Unfortunately, if we were to see the pre-GST regime, we had similar provisions under the VAT law and under the Central Excise and Service Tax law. While Central Excise and Service Tax law allowed refund only for input and input services which remain unutilized, VAT law allowed refund of all taxes, whether it is input services or capital goods. Unfortunately, when the law got merged into the GST law, carrying forward what was there in the Central Excise and Service Tax, the refund provisions now allow refund of only input and input services. Here I would want to kind of share my practical experiences. We have, because I also handle a lot of large export-oriented units, we have seen that there are significant taxes which have been paid on capital goods which remain unutilized for exporters. So we made a representation to say that under section 49, subclause 6, read with section 54, there is a mechanism provided under the law to allow refund of unutilized credit. And that unutilized credit does not have a restriction with respect to whether it is input services or capital goods. But unfortunately, the section, from an administrator's perspective, has a limitation in section 54(3). They read section 49(6) with section 54 to restrict the credits. So because there is a restriction of capital goods refund in section 54, government is very clear, from the administrator's perspective, that capital goods refund will not be allowed, because they believe that capital goods has an enduring life, and if there are stray exports, then there could be misuse of taxes for those stray transactions, and the intent of the legislature may not be fully achieved. So if we were to kind of consider the conservative view, if I'm an exporter and if I have input taxes which are in the nature of input or input services, and if they remain unutilized for supplies which are exported, be it goods or services, I would be allowed refund of those taxes. But if I have capital goods, I can take the credit, and if I'm unable to utilize and if I have a subsequent future liability, I could use those credits to pay those taxes, but I cannot claim refund. So that's the reading of section 54 for zero rating. which allows refund of input taxes. One of the option provided for exporters is that one is, yes, I could consider my outward supplies which are exported as zero rated, or I could consider them as taxable, charge appropriate tax, and claim utilization of tax paid on input services and capital goods to pay those taxes, and after that claim refund of the tax charged on export. So if I can illustrate it, let's assume that I have an input tax credit of 10,000 on inputs. I have an input tax credit on input services, which is 10,000, and I have a capital goods input tax credit of 10,000. So all put together, I have, let's say, 30,000 of taxes on my input services and capital goods. Let's assume that I'm exporting goods worth say 10 lakhs, on which let's assume the rate of duty is say 10%. The total outward tax becomes 1 lakh. What I could do is, rather than treating this as zero rated, law allows me to charge tax on exports, utilize these credits paid on input services and capital goods with the outward taxes, and claim refund of this 1 lakh. So rather than zero rating the outward and claiming refund of 20,000, I'm allowed to charge tax on outward and claim refund of the tax so paid, and from an incidence of duty perspective, prove that I have not passed it on to the person receiving, that is my customer residing outside India. If that be, then yes, this is also one option. But unfortunately, I have a slide which kind of brings about issues connected with rebate. This is called as rebate, where I pay taxes on outward. There are inherent limitations, and the way in which the notification is worded, there are inherent issues connected with that. Maybe I may not want to discuss all of that in this slide, but we will discuss that appropriately when that topic and when that slide kind of comes in. Right? For now, if I were to kind of summarize this point, zero rated is a supply which is in the manner as exported, that is export of goods or services, or through SEZ units. I supply to a SEZ unit or a developer who in turn definitely is engaged in exporting goods or services. So if a transaction is of that nature, that transaction is treated as zero rated. Now, there is no exemption for those supplies. The exemption is only from payment of tax. So section 16 of the IGST law says, wherever you're exporting wherever you have transactions of zero rated supplies, you need not pay the IGST involved in such exports. So the exemption is from payment of tax by regarding the supply as taxable at zero rate. That way, maybe the way in which the law has worded as regards taxability may could have been better, so that people, as I said, there are a few people who interpret or by virtue of the way in which it is, treat or probably also consider that zero rating could also be regarded as exempt supplies consequent to exemption from payment of tax. But very clearly, it is a taxable supply for which the rate of tax, we have to read it as the rate of tax is at zero rate and not nil rate, and therefore cannot be regarded as exempt supplies. And as an exporter of goods or services, either directly or through SEZ units, the exporter is allowed taking credit. There's no need for reversal of any credits connected with such transactions. Credits can be taken in full, and if they remain unutilized in terms of section 54, they are allowed refund of those taxes. And an option is also provided where instead of treating them as zero rated, ordinary rate can be applied to those transactions, and that transaction is regarded as rebate on exports, where the tax charged on outward is allowed as refund, and in such cases input refund will not be allowed. So that's how the meaning of zero rated supplies, its objectives and conditions are explained. I hope I have illustrated in terms of the meaning of both exempt supplies as well as zero rating, and if that is kind of understood, then I'll probably move on to issues connected with zero rating, and then specific issues which I have kind of listed out for the benefit of the audience here. So, Kritika, are there any questions which audiences have raised here?
Till now, no questions. No?
Wonderful. Yeah. So, as I said, if the listeners have any questions, they need not park it to the end. If from a discussion perspective, it is relevant to be raised at that moment, you could share it through a chat message, and then I will request Kritika to raise that for the benefit of the audience, where I could kind of clarify.
So
For
you
now,
will come again once the example what you told, not to export at 0 rate, but to export at the rate as applicable, then you can get the refund of the input which was available without taking the capital goods input.
yeah. So let me illustrate again. Yeah, as you said, let me first take the first option. First option is what? First option is if I'm an exporter of goods or services, and whatever those exports of goods or services are there, I will export it at 0 rate. That is, I don't charge any tax on my outward exports, and on the inputs, that is input services and capital goods, I can take credit of all of them. But if they remain unutilized because I may have only exports, or my exports are more in terms of my domestic liability, and I'm unable to utilize the full taxes paid on my purchases in the nature of input services or capital goods, then law allows me refund of tax. But it does not allow me refund of tax paid on capital goods, but it allows me refund of tax paid on input and input services. So in the given illustration which I had taken that, yes, we have 10,000 of tax paid on inputs, we have 10,000 of tax paid on input services, and 10,000 of tax paid on capital goods. Whatever be the value of my exports, because tax on that is 0, and if I have, let's assume, no other transaction, then this tax which I have paid on input services and capital goods remain unutilized. Government, in terms of section 54, allows me refund of input and input services, but not capital goods. So in this example, 20,000 of refund, I can kind of claim it. And the time limit to claim refund is 2 years from the month in which exports happen. So if exports are done in the month of April 2019, then till March 2021, I have time to claim this refund. Right? Refund has to be done online. A particular form is there. And to be entitled to claim refund, I need to execute a letter of undertaking, and whatever, I mean, in terms of the refund application and formula, I need to kind of give how much is my export turnover, how much is my total turnover, and I need to calculate the ratio which my exports have to the total for that particular month, multiplied to the credit of input and input services. In this example, since my exports are 100% of my total turnover, 100% of transaction remaining unutilized, I'm entitled to refund. Now for refund calculations also, government has provided a 3-way check. One is for the month in which I have exported, the export ratio multiplied to the total credit. So in this case, my export ratio from a simple reason perspective, we have taken 100%. So 100% of the total input and input services, that value has to be compared with the balances lying in as on the date of claim. So April 19 exports, I can kind of claim it till say 2 years from the month of exports. So I have time till March 2021, right? In the month in which I claim, let's assume I claim it in August 20. In the month in which I claim, what is the balance in hand, right? So so compared to the transaction for the month, compared to the month in which I claim refund, comparison of both of this, lower of the two is what I am entitled to refund. In principle, what the government says is, if there is a transaction remaining unutilized, the closing balance as on the month of claim or for the month to which it pertains for input and input services will be refunded. Right? Unfortunately, as I said, refund of tax on capital goods is not allowed, but refund of tax on input and input services is allowed. So there are many exporters who pay significant amount of tax on capital goods, and if they are either 100% exporters or predominant exporters, there is a possibility that the tax on capital goods may remain unutilized, and in the absence of any domestic liability, getting refund on such transactions may practically be not possible. So one of the other alternatives is to pay tax on exports, and that particular scenario situation is called as rebate scenario, where the exporter has the choice to charge tax on outward exports. He should not be collecting that from his customers. The incidence of the tax should be borne by the exporter, and then in such cases there are conditions which that provision has, which as I said, I will discuss it separately. But in terms of the provision, once I charge tax on exports as a normal transaction, I'm allowed to utilize whatever taxes which I have in my SINVAT ledger. So input services and capital goods credit are allowed to be set off against the tax liability on such outward exports. And whatever tax I charge on exports, government will give me refund. So if it is an export of goods, my shipping bill will carry that. And if it is export of services, I'll have to file a appropriate refund application showcasing the amount of tax paid on exports and claim refund. And here again, the time limit to claim refund is 2 years from the date or the month in which those taxes on exports are charged or levied.
So one question from the members, sir.
Yeah.
Can we pay tax for export using ITC on capital goods and get refund on the tax?
Which is exactly what I said. There are certain conditions for which the government has imposed on the ability to kind of pay tax and claim refund. I have a separate slide on that. Maybe what we can do is park this question and I'll address it at that moment. For now, let us let us consider that government has given an option to pay tax at 0 rate or at ordinary rate. If you pay tax at 0 rate, credits on inputs and input services are allowed as refund if they remain unutilized. And if you charge tax at ordinary rate, then the tax so charged is allowed as refund. But there are conditions attached. What are those conditions? We'll discuss in the ensuing slides. And I will address the question raised by the audience at that moment. I move on.
Yes, sir.
Yeah. So whether the 0 rate supply is an exempt supply, I think we have already discussed, or exempted by virtue of notification. So clearly the exemption is from payment of tax and not the supply itself, and therefore cannot be regarded as an exempt supply. One of the conditions for doing an export is execution of a letter of undertaking. Now this is something which is not new into the GST law. Under the central excise, the service tax law, and the VAT laws, each state had different rules connected with execution of letter of undertaking. Now, under the central excise and service tax, the purpose of execution of letter of undertaking was that if I remove goods which are excisable, or I render services which are exported, and I don't realize consideration, or for whatever reason they're not actually exported, then ordinary taxes payable on those transactions become payable. Similar similar provisions are there in the GST law. So an exporter is allowed to export provided he's executed a letter of undertaking. Fortunately, in the GST law, the ability to execute the LUT is through a simple login. After I log in into my as an assessee into the GST portal, I'm allowed as an option to submit the letter of undertaking. So it's a simple click of a button. And fortunately, again in the GST law, it allows me to execute this LUT anytime during the year. So there is a possibility that I may have exported in this month, say month of August, but I could not execute the LUT before export. From the way in which it is seen, it allows me to execute LUT even subsequently. But the audits under the GST law as today are still happening or not concluded in many cases. So we have basically practically not seen issues being raised with respect to LUT as today. But in my personal view, I believe that execution of letter of undertaking should not be regarded as a substantive condition, but only a procedural one. Substantive is actual exports. So we have evidences in the nature of shipping bill and soft X's in the case of software exports and otherwise. So to substantiate an evidence that exports happened. A letter of undertaking is procedural to the extent that in the event I'm unable to kind of realize consideration for export of services or export the goods in particular, then I am required to kind of pay the applicable taxes. So since one of the conditions to export are anyways not fulfilled, that transaction is not regarded as export, and through the undertaking, I undertake to kind of pay those taxes. So in my view, execution of LUT definitely procedurally has to be done before exports, but if it is not done before exports, it should not be regarded as a substantive lapse, and the legislature will have to kind of take a lenient view as regards them and consider that as a procedural lapse. That is one. Similarly, we have seen there are significant fluctuations in how the Indian rupee has with the other foreign currencies. So many exporters have to kind of ensure that they are not imposed with, or probably they are not, they don't have a situation where they have to bear the burden of foreign exchange fluctuation in terms of a negative kind of loss in terms of foreign exchange transactions. They export goods and services in Indian rupees. Right? Fortunately, the Reserve Bank of India has made rupee fully convertible for current account transactions. So ordinary purchase and sales which I do, I'm allowed to export in INR. And there were definitely more than one circulars and notifications in the FEMA provisions, which enabled that wherever the amounts are realized in Indian rupees from a source which is outside the country, it is treated as if it is equivalent foreign currency. And to that extent, that transaction is as if I have exported in for convertible foreign exchange. However, there were a lot of litigations surrounding that because of the issues being raised by lower authorities. There was fortunately an appropriate amendment which happened with effect from 1st of Feb 2019, which probably I would say set to rest this dispute, which said that even if in terms of wherever RBI permits realization in INR, the transaction is sufficient to be regarded as exports as regards that the conditions for exports are required. So maybe I may pause here. If the audiences have any questions, I'll be happy to kind of clarify them and then move on to specific issues which I have kind of listed out. So there are about, yes,
so you can go on.
We can move on, yeah. So there are about 10 to 15 such specific issues which I have listed out. Maybe in the, each may take about 5 minutes. So maybe around 6:20 or so is where we will have hopefully kind of covered all of them. And then last 15 minutes or 10 minutes, I'm sure we will have sufficient time to address any questions which we may have. And as I said, if addressing those specific questions also, if the audiences have, you could kind of raise your questions then to clarify that particular issue. Now, one more interesting question is the requirement to reverse ITC on export of samples. Now, we know that exports are zero rated. If I were to export, say, samples worth 1 lakh, since I don't realize any consideration, right, is there a need to reverse the input tax credits? Now, we know that in terms of section 16 and in terms of section 17, if the supply is treated as an exempt supply, then the input taxes relatable to such exempt supply need to be kind of reversed. And in terms of section 17(5), specifically, if there are removals of sample, the ITC is connected with that value will need to be appropriately reversed. Now, I would say unfortunately, section 17(5) does not distinguish removal of samples whether for domestic or for exports. So whenever I have export of samples also, technically the taxes paid on inputs need to be kind of reversed. Now this would be regressive as regards the intent of the government for exports is kind of concerned. But the way in which the provision is worded, yes, there is a requirement for reversal of, if you were to read the provisions literally, there's a requirement to reverse appropriate input tax credits on such transactions. So in my personal view and the review of books of accounts of certain large SSEs, this is something which many SSEs miss doing so. So, so it is very important for practitioners or for SSEs in industry to make note of this particular point, where wherever there are exports of samples, the way in which the statute is worded, there would be a possibility or requirement to reverse ITC. One cannot consider them to be zero rated and probably presume that the need for reversal may not arise. But here again, if one were to kind of probably take the other side of the law, one could be aggressive in taking a view that zero rated supplies can be for a consideration and can be without consideration. And once it is a zero rated supply, consequent to a specific provision which enables me to take ITC credits on them, that particular transaction may not have the requirement to reverse ITC. So I would say that that would be an aggressive view for the reason that here is a case where there is a specific provision for reversal of ITCs with respect to removals of supplies which are connected with removals of samples. So let's move on to certain specified issues which I have kind of taken for the benefit of the audience. Now, all of these issues are connected with exempt supplies or zero rated supplies. Maybe we can kind of go issue by issue. As I said, there are about 10 to 15 such issues which I have listed out. The first issue is connected with educational institutions. And I'm told by the chairman of Pondicherry branch that there are many SSCs here who are in terms of who are listening, who basically have who have either SSC who are connected with educational institutions or have clients in that particular segment. And I was told to kind of probably clarify any specific issues connected with them. So maybe I'll probably illustrate it both charitable as well as education. Second point is on charitable and this is on education. I'll try and kind of illustrate the various issues connected with them. Now we know that services provided by educational institution is a transaction which is exempt from GST. Now, if you were to see the way, I mean, not only in the GST regime, but in the pre-GST regime also under the service tax law, such services were exempted from the levy. Now, the definition of exempt, I mean, if you see the listing in the exemption notification, the only line which reads as a services provided by educational institution. It does not in any manner bring about any conditions whatsoever connected there. But the definition of educational institution says which is the educational institution which provides these services which would be exempt. So the definition of educational institution reads as institution providing services by way of preschool education or education up to higher secondary school or equivalent. Similarly, education as a part of curriculum for obtaining a qualification recognized by any law for the time being in force. And education as a part of approved vocational education courses. Only when the services are rendered by such institutions, there would be an opportunity to seek services provided by them as exempt. Now, there are certain issues connected with zero rating or exempting these particular supplies. Now, let's take an example. Now, we know that if you see the definition, it says education as a part of curriculum. Now, many times when we are enrolled, I mean, we would see that educational institutions probably collect fees for activities which are not part of curriculum. Right? Now, let's take an example where I may have summer coaching, swimming fee which is collected from students, or I may have an add-on abilities training which may be for music or anything as such. So, or there may be additional hours or efforts which are put on to a particular student for which there's an additional tuition fee collected. Now the question is, are all these fees part of or outside the curriculum? Let's take another example. Now, if I have to admit a student to the school, there is an application fee collected from the prospect applicants. There's a possibility I may have, let's assume 300 seats, and the number of applications may be, let's assume 3,000. So as against 300 seats, I have received applications for 3,000, and I collect an application fee which is not refundable. Now, whatever application fee which I have collected is for if the student gets selected, is where he gets admitted to the institution. Otherwise, that fee is collected and enjoyed by the institution. Now, is that also a services for? I mean, if it is regarded for the students admitted, probably one can say yes, it is part of the education services provided by the institution. But what about the students who are not admitted? Of the 3,000 students, only 300 get admitted. 2,700 students have not been admitted to the institution. So it is it something which is incidental to services provided? Is that also something which is exempt, or we'll have to read it strictly and say that these are provided by educational students, not to the students or faculty of that particular school, because they have never been admitted, and therefore that fee cannot be regarded as an exempt supply. So definitely the way in which the definition is worded, only those fees which are part of the curriculum and collected from those students who are enrolled into the institution are or would be exempt supply and not otherwise. So we have seen in our practice that I would say generally all schools and all institutions consider the entire application fee or additional fees part of the activities like swimming or music or otherwise as part of the curriculum and treat them as exempt. But yes, there could be potential litigations connected with those nature of incomes. It may be advisable to offer that portion of income as taxable. That way. Yeah, I move on to the next practical issue. The second is connected with charitable institutes. So there are more than one entries in the exemption notifications exempting transactions connected with charitable activities. I've kind of probably taken one of those as an illustration. Now, the definition of charitable under the GST law is definitely quite restrictive as regards the general understanding of what is charitable in nature. Definitely, the meaning, we'll have to kind of look at the meaning of charitable activities in the GST law for it to be kind of treated as exempt. So if the activities of the charitable institutions fall within the meaning of section 2R of the GST law, then alone is that activity considered to be services rendered, and there again by a trust or a unit which is registered under section 12AA of the Income Tax Act, not otherwise. That way. Now there are just because it is received, the incomes are received by a unit which is 12AA registered under income tax, does not mean that all incomes by such charitable institutions are exempt. There are many NGOs who receive various donations and various forms of incomes. Not all forms of income is an income which is exempt under the GST law. Let me take a simple example to illustrate what I'm basically stating. Now, it is ordinary that the funds collected by charitable institutions, one of the major sources is from donations. Let us consider that, yes, what is donation? Donation is something which the person giving expects nothing in return. So if I'm giving a donation to a particular hospital, I expect no treatment in return. If I give donation to school, I do not expect an admission in return. Wherever the purpose of giving donation is to expect something in return, then it is that something in return becomes sufficient consideration for donation, and then it can become taxable. So the example which I gave of the educational institution, if I give donation to the school on the condition that my kid gets admitted to the school, that donation is not, it cannot be read as something which lacks consideration. It is an adequate consideration. For the charitable institute, if I give a donation to say my name, the person who's donating, his name needs to be displayed or my brand needs to be promoted, right? Then the fact that I'm displaying the brand of the person giving on consequent of a specific condition, that donation would be sufficient consideration and liable to tax as such. So that transaction may not be regarded as an exempt supply in the hands of charitable institution. So let's say that Infosys Foundation, which is a charitable institution, receives funds from say a corporate, and let's say they create a fund for construction of a building, and on that building they probably put their name. So let's say Wipro, for example. The block, yeah, one moment, yeah. So the block is named against the person who's giving the donation. So consequent to such, because there was a specific direction by the donor to say that I would give you donation. Yes, it can be applied for various purposes, but one of those conditions is that my name needs to be kind of promoted. In such case, the fact that my brand is getting displayed or the benefit is being enjoyed in terms of brand promotion, that particular donation may not be free from exemption. However, so as I'm saying that However, so if the charitable institute does that without the condition or the requirement from the donor, as a honorary mention of the donor's name, in such case, mere display of the list of donors or without the specific condition of showcasing the brand, then such donations should not be regarded as for a consideration and therefore continue to be exempt in the hands of the charitable institute. So a charitable institute which does public health, which does advancement of religion would fall within, I mean, as I said, there are more than one categories. I have just taken one to explain the intent. So wherever the activities fall within them, services connected by those, if there is a fee collected for such services, those will not be treated as taxable transactions. But wherever it is beyond them, wherever they either the fee collected or otherwise is not which meets those conditions or those requirements, or which is beyond them, so those incomes and those receipts will, even if they are 12 AA registered institutions, they will be, such incomes will become taxable. Okay. So any questions connected with educational institutions or the charitable institutions before I move on?
So till now, no questions was received regarding the charitable institutions.
Good, yeah. So I move on.
Yes, sir.
Yeah. So as I said, what I have done is largely for the transactions which are either exempted or zero rated, I have picked up certain key points which may be connected with the issues surrounding them. So that's how it may be. I'm sure there are many more than what I have listed. One should not construe that it is only those. These are only illustrations to the many issues which we have on these topics. One of the other interesting issue is with respect to sale of units on a going concern. Now, the government, when they probably introduced the draft GST law, there was a listing of exempted transactions. In that, sale services by way of transfer on a going concern, that is sale of a unit on a going concern, did not have a mention. In the second draft, right, which came in November 2016, the government introduced that they would want to exempt these activities through a particular notification. Now there is where the issue is kind of now how now what the government has done is in the jumbo notification granting exemption, they have listed out and said that services by way of transfer of a going concern unit, right, as a whole or an independent part thereof, is exempted. So if I have sold, if I have, let's say, in the legal entity I have, let's assume I have a particular unit. I have sold that particular unit, but not the entire company. That particular unit on a going concern, that means to say all assets and liabilities are transferred. Then that particular supply is treated as exempt and I don't have to kind of pay tax. That transaction is subject to tax at zero rate. Now first is it would have been appropriate to have this particular transaction to be put into the list which is neither goods nor services. Unfortunately, government has listed out this particular transaction as a transaction of an exempt supply. Now what is the implication of putting this into an exempt supply? Let's assume that in the example which I said, I have two units. One unit I sell it on a going concern basis for a particular value. While I don't have to pay tax on that sale value, because it is treated as that consideration which I earn, because it is treated as an exempt revenue, under section 16 and section 17, I may have to reverse the credit attributable to this exempt supply, right? So if I have accumulated credit of an X amount, that X amount of credit needs to be multiplied with the exempt turnover. And we know that when we sell a unit, it is definitely of a substantive value, right? that value divided by the total turnover, which I have, becomes the ratio in which my credit will need to be kind of reversed. Now this is obnoxious, right? When I have sold the unit or transferred the unit on a going concern basis, all assets and liabilities are transferred. When I do that transfer, the assets, the certified balances connected with that unit are also being transferred. So why should there be a need to reverse credit? Unfortunately, because they have treated this particular transaction as an exempt transaction, by looking at the plain reading in which the law is worded, or that's how they have kind of done, there is unfortunate requirement to reverse ITC. Now, in our experience, we have seen so many mergers and acquisitions, and we have seen mixed responses as regards reversal of credit is concerned. Substantively, no unit has reversed ITC, but definitely there are units which want to be cautious and not aggressive, have taken a position to reverse ITC. So what has this done? It has basically kind of created two scenarios, right? Those assessees who have not done, consequent to assessees who have done, are now, whenever audit happens, would now get exposed to the need for reversal of transactions of such nature. So as I said, it would have been appropriate had the legislature treated this particular transaction as a transaction which is neither supply of goods nor services. But unfortunately, they have treated this as an exempt supply. The second relevant point with respect to transfer of a unit on a going concern is all assets and liabilities. Now, we have seen that whenever there are units which are transferred on a going concern, at times all assets and liabilities are not transferred. Some assets and some liabilities remain with the unit which is transferring. In which case, can you kind of consider that it is a transfer by a going concern? Now, that would depend on what is the asset or liability which is not transferred. It may be advisable to ensure that wherever it is a transfer of a going concern, if all assets and liabilities are transferred, retention of some liability or some asset should be avoided. There are certain decisions in the income tax law and otherwise which have said that even if there is some retention of some assets or liabilities, either whether they may not be connected otherwise, but substantially we have still interpreted that to be a transaction in the nature of a going concern. But decisions of income tax may not at times apply directly to the indirect tax law. So there is a possibility of litigations wherever all assets and liabilities are not transferred. So one would, and the implication is what? Once it is not a transfer by going concern, means where all assets and liabilities are not transferred, the entire consideration would then become a taxable supply and tax would need to kind of be paid. In which case, I may have to kind of look at the items which are being transferred, attribute the sale consideration to those items, and then discharge the tax appropriately. The worst case is what? While I'm from arriving at the consideration, I may have gross value of assets less the liability, and then there is a goodwill attached. Right? Unfortunately, the deduction of towards liabilities may not be allowed, and the gross value of the assets without reduction of liability would be treated as the consideration, gross consideration for this and taxed as such. So if a transaction is not a transaction in the nature of going concern, it may have huge implication on the transferor. Therefore, it may be advisable to ensure that the position here should not be aggressive, and all precautions as necessary should be kind of considered there. I hope I have illustrated the issues connected with sale of a unit on a going concern. I move on to the next one. One of the exemptions is on services by way of renting of a residential dwelling for use as residence. What do we make out of this line? Services by way of renting. Renting will include lease, right? Of residential dwelling for use as residence. Why has the authority or the administrator or the legislature, from a choice of words, used it as residential dwelling and residence, right? So if the words did not have residential dwelling and the words could be only used as residence, then probably hotels which are used as residence or corporate guest houses which are used as residence could also become probably exempt. But the way in which it is worded, services by way of renting of residential dwelling, that means it should not have a commercial use or objective, for the purpose of residence alone are exempted from GST law. And once services connected with renting of residential is not subject to GST, naturally so, I mean, whether it is for commercial or otherwise, there is definitely a lot of disputes connected with the entitlement to credits in the hands of landlords, right? From the pre-GST regime to the GST regime, the authorities have had a consistent view to hold that for renting, there are no related input and input services unless it's a transaction connected with maintenance, which is subject to outward tax. The input and input services connected with creating the facility, that is the premises to be given on rent, are not eligible for credit, because section 16 and section 17 has specific restrictions connected with taking credit or availing credit with respect to immovable properties. Now, why has the government chosen not to give credits on immovable property is a choice of the legislature. Government has done what government could do, right? And we have also, and it is not unique to India. If we read the European VAT laws or other international laws, there also in many of those statutes, the credit related to immovable properties are probably denied. Why so? It could be that yes, one is the residential building could have a longer life, and the taxable activities from the use of the building could may not be fully or attributed to the full life of the immovable property. So just to illustrate, the immovable property may have a life of, let's assume, 50 years, but I may give the property on rent only for 1 month or 2 months or 3 months, right? Then if the credits on activities connected with construction of the entire building is allowed, then there may be a disproportionate. All the credits only for the 3 months of taxable activity will become eligible, and that's not the intent of the legislature. So therefore, thoughtfully, the legislatures have probably felt not to allow credit, but we have seen that there are certain decisions which have probably given room where, of benefit to the assessees who construct structures only for letting it out. So the objective of constructing the immovable property was only to let out. In those cases, we have seen, I mean, there's one Calcutta High Court decision which has been favorable to say that credit ought to be eligible. But yes, it's highly litigative. The conservative view would be to consider not eligible. So in the context of residential dwelling, the issues connected could be as to what is meant as residential dwelling for residents. So so company guest houses, while they house employees for use as residents, but they are not residential dwellings, they are corporate guest houses. They have the commercial objective in terms of them. Similarly, a hotel or such other lodges, where an assessee can book a room and use it for residence, which is not temporary, but on a reasonably long term. There also, because the objective of that the premises is commercial in nature, there also the exemption may not be available. So the intent of the legislature is only to grant exemption for residential dwellings, that is non-commercial, and when used for residence. So in a residential dwelling, commercial activity comes in, again taxability kind of comes in. So both conditions have to be satisfied. One is non-commercial dwelling, non-commercial use, that is residence, in which case the exemption from GST is there. So that rent or that lease would not be subject to GST on outward supply. I hope I have clarified the issues connected with renting. I move on, yeah. So the next question is with respect to taxability of healthcare services. Fortunately, under the GST law, healthcare services have been exempted from the levy, right? So, and healthcare services has been defined elaborately under the GST law. So services by way of healthcare services of a clinical establishment or an authorized medical practitioner or a paramedic, and services connected with the transportation of patients in ambulance, right? Those services are considered as exempt services. Now, we have seen in our practice that naturally the healthcare services, which are not only for treatment of patients, the hospitals which treat those patients also have supplies of medicines, consumables, and surgical items which are needed for treatment. So the question was whether those supplies which are connected with treatment of patient during the treatment, whether exemption can be applied to them. Now, the consistent view has been that yes, this is a composite supply. Composite supply meaning that yes, the primary objective or the principal objective is healthcare services, that is to treat the ailment in a particular individual. So that treatment requires administration of medicines, usage of consumables, and such composite supply, because predominant being the healthcare services, such composite supplies are exempt, and therefore supply of those medicines ought to be kind of exempt. And fortunately, we have an AR ruling supporting that also. And in the pre-GST regime, under the VAT regime, under the service tax regime also, authorities have probably taken a consistent view. Wherever statute, like say in certain state VAT laws, there was a specific mention to say if there was sale of medicines during treatment, medicinal treatment, those sale of medicines have to be treated as taxable, right? Unless it was in the exempted schedule. So only in those cases where under the VAT law they were taxable, otherwise they were generally exempt. So hospitals giving medicines to patients, inpatients, are treated as composite supplies, not taxable. But it is not far away, because the way in which certain hospitals make margins on those sales, and particularly if you were to see, they have back-end commissions, means to say that they may sell medicines on MRP, but the back-end commissions are quite lucrative. Sometimes it is like 40%, 60% of the MRP. Now, in such cases, while they have purchased medicines at 100 but sold it at 200, the question is that has become a commercial activity, and such commercial activity should it be treated as distinct supply rather than treating it as a composite supply. And one of the conditions in composite supply is also that the itemized billing should not be there. That means there should be a single charge or a price for the entire supply. But when we see the hospital billings, definitely we see itemized billings for medicines and billings for other transactions connected with healthcare services. So yes, it's not that this issue is free from ambiguity. The way in which this sector is operating, and the way in which the law is worded, there is good amount of possible litigations. Right? If I am representing the department, I could say that yes, because there is a separate value attached to those medicines, we move away from the meaning of composite supply, and they are to be treated as separate supplies. In sale of medicines, if the same medicines were to be sold from a pharmacy, is taxable, and so should it be, even if it is sold by an hospital. That way. So yes, if one were to kind of consider it to be minutely observed, definitely there is a possible litigation surrounding this subject. So this is something which I wanted to kind of highlight along with this particular topic. Right. So before I move on to the next, any questions which have kind of come here for me to kind of address them before I move on?
No, sir.
Wonderful. Yeah.
Yes.
So the next, issue is I would say this is something which is a burning issue in many cases, is the ability to tax.
Shall I ask you one question, sir?
Yeah, so what I suggest, it may be good to, while you can ask now, anyone who has questions could kind of write it down and send it to Kritika, and then we could kind of address it. So that what happens is the audience is listening, don't kind of, they hear only one voice that way. Okay, yes, okay. Please. No, you can, since you have raised this,
sir,
please raise your question.
You talked about the education field, meaning that swimming and all, they are charging separately. But the student, sports is essential, and from our period, physical education is part and parcel of the normal education. Therefore, swimming and all are extension of that only. And government is also encouraging sports activities at state level, district level, and all. Schools are participating, students are participating on behalf of the school. Then how can we say that that is not part and parcel of the education, sir?
No, I'm not. Yeah, wonderful. I think what you raised is a very wonderful point. Yeah, I understand you're Mr. Srinivas, right?
Yes, sir. Srinivas, sir.
Wonderful.
I am Srinivas Sriraj, sir. Sriraj.
Wonderful, Mr. Shri. So I think the question what you raised is very relevant here. So let me just add on. Now, if we were to see the curriculum specified by government in the state, central, and the ICSE syllabus is definitely not exhaustive, and in certain cases illustrative. Now there is one what do you say class which we have, which is like PT, playing time, and there are certain as you also raised that yes, as part of the curriculum, certain of these sports related activities are considered to be essential. But you would also appreciate that many schools, like say, unfortunately, there's a possibility you may have schools which don't provide these sports activities and just concentrate on education. They are also something which is recognized, and there are these schools which provide more than ordinary. Right? So in the definitely we have 1 hour of playing time probably in a day or in a week. These institutes definitely provide more than those in terms of hours. So there is no limitation in terms of the time there. And some of these educational institutions also provide this as part of, let's say, the school days are considered to be, let's assume, 160 days in a year. So during the summer vacation or during holidays, which could be, let's say, for Christmas or Dashera, these schools provide extra, what do you say, opportunities to people to kind of pay a particular fee. So it becomes optional. You pay this and then you can avail that facility. So if it is a curriculum, it is something which is expected to be mandatory for all. Wherever there is an option given to students, so in a set of 1,000 students, 100 students opt for that particular activity. The question is it part of the curriculum? And once you give an option, it is probably assumed as not part of curriculum. And therefore, that particular income, which came through an option exercised by few students, may be treated as taxable. We also know that schools organize picnics, right? It is not mandatory for every student to opt and go for picnics. The essence is the school intends to kind of collect a fee for ensuring that the cost involved in the leisure activity is recovered from the students opting. So there also, it is not part of curriculum. It is a choice which some schools or educational institutions provide. Wherever there is a choice of that nature, the view taken is that it may not be part of curriculum, and that transaction may therefore become taxable. So that's what I wanted to highlight here.
Is it okay? Shall I ask one supplementary, sir?
Yeah. So what we'll do, I have certain. I'm sure we can keep discussing on a particular topic.
Fine.
As I said, the intention is to kind of highlight some of the views. What I would request is, whatever is in your mind, please write it to Kritika.
In the chat box, sir.
Definitely. Okay, fine.
Yeah.
Thank you.
At the end, basis the time, I'll be happy to kind of address them. So whatever you've raised is really very relevant, and it is really required for people wanting to kind of take this or probably what do you say have the full understanding of the particular topic here. So I totally appreciate that. Thank you so much for that. So maybe these questions in between as they come is also definitely helpful to kind of ensure that we are able to kind of address the issue then and there. But at the same time, if we were to restrict it to few, it would be more relevant to the larger audience here. So it is only with that intent. So let me move on to the next issue, which is highlighted, is the question on recoverability of electricity and water charges by the landlord from the tenant. Now we know that what is exempted under the GST law is one is supply of electricity is treated as goods and exempt in terms of notification number 2, and the transmission and distribution of them is also exempt provided it is done by the appropriate state electricity board. Wherever it is a transaction other than this, right? is the question is, like say if I generate electricity through diesel mode or through solar or otherwise, and there are common electricity charges which are probably it's just sharing of expenses at actuals or at times in terms of recovery of some nominal markup. The question is, wherever I have recoveries towards electricity and water, whether they would be treated as pure agent recoveries, not taxable, or is there a what do you say, whether the transaction can become that recovery can become liable to tax. Now there's one AR which has kind of unfortunately considered this recovery as a taxable transaction. Now it is not to kind of go with the view of the AR, but it is basically to kind of if there are definitely several decisions in the service tax regime which have kind of consistently held that such recoveries, if so long as it is towards cost, should not be considered as a taxable supply. But the view, the way in which the statute has worded in the GST law vis-a-vis what was there in the service tax regime also definitely is not quite different. So one view is yes, that those decisions in the pre-GST regime should have equal binding or be equally kind of be available to be kind of relied upon even in the GST regime. But the way in which from the words in the statute here definitely are not identical and they are a little different. So to that extent, yes, the fact that this AR has kind of considered this as taxable will only mean that there could be a good amount of litigations around that. And in the service tax regime also, we have seen that there was an amendment in the service when the service tax law was there, which basically said that only when all the what do you say, developers who basically collect electricity charges from those tenants or units there was a clear kind of provision to say that it will not be regarded as an exempt supply and ought to be kind of considered. So there was a statutory amendment, and which is what in the GST regime also it is considered that that if there is any recovery done by a landlord from towards electricity, that may be considered as liable to tax. And we have also seen that as a matter of abundant precaution, because landlords or the developers would not want to kind of take a position which is debatable, have started leaving GST on such recoveries. But still there are many assessees who consider this to be a pure agent, whether the landlord pays it or the tenant pays it. It is usage by the tenant, and therefore there should not be, the landlord should not be liable for such. So it would be advisable wherever there is recovery to have the tenant pay directly to the state electricity board or the water board, so to kind of avoid any implications around the ability of the landlord to recover. But whether it is paid by the tenant or by the landlord, one cannot dispute that it is part of the larger renting services. And from a valuation perspective, any services connected with usage and enjoyment of the property, including charges connected with the electricity and water, ought to be kind of considered from a valuation perspective as includable. And with that, we cannot say that it is free from doubt on taxability as regards inclusion of those transactions are concerned. But yes, my personal view is wherever it is without markup, wherever it is a separate meter, wherever it is the actual cost of the usage by the tenant not connected with the common area, that particular portion, if paid directly by the tenants to the board, has good reasons to consider this as non-taxable. But wherever there are markups, wherever it is common usage, which are from the wordings of the agreement to be also considered as part of usage rights, those values, even if collected separately or otherwise, would become taxable and ought to be considered as taxable. Okay. Move on to the next one.
Sir, there's one question, sir.
Yes,
How to prove that is a pure agent?
Yeah, so the pure agent conditions are what? Pure agent is basically a case where I'm paying on behalf of somebody. Now, in the context of electricity and water, the bills are in the name of the tenant. So one of the pure agent conditions is it is paid on behalf of another. Now, so the authorities who take a view to say that it is taxable, basically take that particular point and say, see, it is not pure agent because it is paid by the person who owns the property. So he is the one who's the owner and he's the one who's paying. It is immaterial whether he uses it or he lets it out to somebody to use it. And therefore, pure agent condition should not apply. But the other view is tenancy is a legal right where I can alienate the rights to use the property, and the charges of electricity and water are based on consumption, and it can be very clearly through the separate meter, it can very clearly be attributed that it is used by the tenants. So merely because the landlord paid it and recovered it from the tenants should not take a view to say that it became taxable. So had the landlord paid it directly, still those services, whatever taxes are there on those services, have already suffered taxes. In this case, electricity and water both are non-taxable, but whatever be, whether it is taxable at zero rate or exempt or otherwise, has already suffered. So mere recovery from the tenant for usage should not again become taxable. So when I pay on somebody else's behalf, so electricity and water, which are for usage charges paid by the landlord on behalf of the tenant, ought to be considered as pure agent and therefore not be considered as liable to tax. But the advanced ruling which I have highlighted in my slides has considered the provisions to say that yes, one of the pure agent conditions will not be applicable. In fact, the discussion around pure agent is unfortunately not as elaborate, and therefore considered to be as part of the larger value of services offered by the landlord to the tenant and considered it as taxable. So does this clarify?
Yes, sir.
Yeah. So we move on to the next one. We know that services which are.
Sir, it can be little louder, sir. Your voice is very low, sir.
Voice is little low. Is this better?
Yes, sir.
Is this better, or should I increase the volume?
Somewhat, if we increase, it will be better for all of us.
Yes, I will do that. Yeah, is this better?
Yes, sir. Now it's okay, sir.
Wonderfully.
Yes.
So we know that services rendered by SEZ units largely are exports, and on the outward front, to the extent it is exports, are anyway zero rated. To the extent that they are supplied by SEZ units to the DTA, it is treated as if it's an import by the unit receiving services from SEZ, and applicable taxes are charged thereon. Similarly, as an SEZ unit, import of services, there is a notification granting exemption. Now, when a DTA unit receives services from SEZ, the analogy or the question is when they're buying goods or services from the SEZ, it is treated as import. Similarly, if likewise, whether if there could be domestic service providers who render services to SEZ unit, would it be treated as import in the hands of SEZ units? So unfortunately, the way in which the definition of import of services is defined, if you see section 210, it reads as what? It reads as where the supplier of service is located outside India, the recipient of the service is located in India, and the place of service, supply of service is in India. Now, wherever there are domestic service providers who are located in India and render services to SEZ unit, they do not fall within the definition of import of services, because this definition has not been defined only for SEZ. It has been defined generally, and in fact, the definition of interstate supply also is so defined to say that if I'm a service provider rendering services to SEZ unit, whether the unit is located in the same state or outside the state where I am, that transaction is treated as an interstate supply. So any services or any supply of goods to an SEZ unit, it is treated as if it is an interstate supply. So given that analogy, so there could be domestic services which are liable to reverse charge. Like take the illustrative example of legal services. So an advocate who raises an invoice on an SEZ unit, he is within India, the SEZ unit is within India. For the SEZ unit, it is not treated as import of services, and it is treated as if it is an interstate supply of services in the hands of the services of the person rendering, and therefore may not get exempted under the import of services exemption notification, which is number 18 of 2017. And once it is not exempt as import of services, the SEZ units will be required therefore to pay this tax under reverse charge, claim credit and claim refund if they are not able to utilize. Many SEZ units are of the view that because import of services is exempt, even domestic services which are liable to reverse charge are also as if it is import and not taxable. But that view may not hold the test of law. So domestic services rendered to SEZ unit therefore may not be regarded as import, and reverse charge, if these services are liable to reverse charge, SEZ unit is advised to pay the GST on reverse charge, claim credit and claim refund if they remain unutilized. I hope I clarify this particular issue here. I move on to the next one. The next is with respect to the export rebate. I mean, this is something which in the context of export of zero rating of exports, I said that we will discuss at an appropriate slide. So let me kind of explain what is export rebate here and the issues connected with this. In fact, government, unfortunately, the way they have issued various notifications, they themselves are unclear, right? So we are probably testing the waters here. So let me kind of illustrate the issue here. Now, government has issued a notification which has been amended over a period of time. We know that when the GST law kind of came in from 1st July 17 to 23rd October 17, there was no exemption on imports by EOUs, right? The exemption was introduced on 23rd October 17. So between 1st July 17 to 23rd October 17, if EOUs were importing goods, they were required to pay. They were required to pay the IGST components on imports. Effective 23rd October 17, government fortunately allowed EOUs to claim exemption of IGST, which is payable on imports. And anyways, basic customs duty was exempt that way. Now, with that particular notification, government also the option to pay tax on exports introduced certain conditions. So if I am an exporter who's exporting goods, the notification number 16 says that, let me read what they currently say, and I'll probably illustrate what it was stating earlier. What it currently says is, if the exporter has availed certain benefits, then he is not entitled to pay tax on exports. Now, what are those benefits? One of the benefit is the IGST exemption on imports. So if I am an exporter who is an EOU, if I have imported certain goods and if I have availed the IGST exemption, then I'm barred as an exporter, I'm barred to pay tax on exports. Like that, there are certain other benefits which the notification illustrates. So if I have done any supplies against advance authorization, or if I have certain supplies to merchant exporter at defined rate, if I have availed certain of the, I mean, there are around 4 or 5 such benefits, which if the exporter has availed, then he is debarred from paying tax on exports. Now, let's assume a situation where definitely paying tax on imports as IGST is optional. At the time of import, I can choose to pay IGST or claim exemption from IGST. Now, if I were to choose to pay IGST, the question is, will I automatically become eligible to pay tax on exports? And the way in which the notification is worded, unfortunately, it does not answer or illustrate in any manner this particular point. So it basically says, I mean, I do not know whether I have to go back to time immemorial, or is it something which is as on the date of exporting. So given the ambiguity, we represented for a specific clarification from the Chief Commissioner and then to the board that way. Unfortunately, we are still awaiting. The way in which the notification is worded, it says that if you're an exporter and if you have availed certain benefits, which include import duty exemption on imports for IGST or supplies against advance authorization or to a merchant exporter, it also had EPCG, which was subsequently removed. If you have availed those benefits, you are not entitled to pay tax on exports. And we have seen that this notification number 16 of 20 has seen various amendments. From 23rd October, there was after this imports became exempt for EOUs through notification. In January, we saw a retrospective kind of notification coming in. Then January of 2018. Then in the month of August, again of 2018, and then again in the month of Jan 2019. So government has been amending these notifications retrospectively. First, one of the conditions first was in the hands of that these benefits have to be availed initially when the notification came in. The condition read as the suppliers to these units should not have availed. That means if I was an EOU and I'm supplying to another unit, I should not have, I mean, my supplier should not have availed those benefits. If my supplier has availed import duty benefit, then I am restricted. So there was absolutely no correlation between me exporting on payment of duty and my supplier availing some benefits. I do not have any control on what benefits my supplier has availed. Having understood that it is an impossible condition, they amended the notification to say that the notification then read as the person who's exporting should have availed those benefits, and if he has availed, then he's debarred from paying tax on exports. So to put it simply, if I am an exporter wanting to pay tax on exports, I should not be an EOU who has availed import duty benefit on imports. If I am an EOU who has availed import duty benefits on EOU, I am debarred. I cannot pay. I do not have the choice to pay tax on exports. Similarly, if I am a supplier who supplies against advance authorization, so if somebody has advance authorization and my supplies are against those, I already have an advance authorization. If I have supplies against those advance authorization, then I cannot be entitled. Or if I supply to merchant exporter at a particular rate, then I cannot have the option to pay tax on exports. So we don't know whether this is a this condition has to be read as 1-to-1. That means to say those inputs on which I have availed benefit, only those which are contained in finished goods and exported, only that, or it is generally. The way in which the notification is worded, it appears that it is generally. That means the exporter is barred. So I may have one stray instance of a particular benefit availed, then I as an exporter am debarred. So definitely the way in which this notification is worded is far from being I would say legally enforceable. It has a lot of lacunas around the way in which it is worded. And the fact that it came in through various retrospective amendments, and the fact that legislature has in the initial it brought in a condition not on the exporter but on the suppliers to exporter, having realized it cannot be implemented, brought in as a condition on exporters themselves. So legislators themselves don't know what is that they would want to achieve by this particular provision. Simply, whether I am an EOU, whether I am non-EOU, I should be allowed to pay tax on exports. Worded now, if I am an exporter who has availed import duty benefit, which is in the nature of IGST exemption on my imports, then on my exports, I'm debarred. I'm not allowed to pay tax on exports. So that's an unfortunate condition. But as I said, legislature has the power to probably impose conditions into the statute, and this is one which they have kind of done it very absurdly, and this is how it is. So unfortunately, if I want to pay tax on exports, I should not be an EOU, or I should be a person who's not availed those specified benefits given in notification number 16 of 2020. I hope I have clarified the point raised previously. If not, confused more.
One more question, sir, from the participants.
Yeah.
This should be benefit from the export review, whether LUT or EOU would be beneficial.
Yeah, see, from an indirect tax perspective, if I'm an exporter, EOU allows me, earlier EOU allowed me income tax benefits and other benefits. Unfortunately, government is moving away from creating a separate status for EOUs. In fact, now the benefits are largely the indirect tax benefits, so which are not attached as if you are an EOU or otherwise. So every exporter can kind of get the same or similar benefits which an EOU enjoys. Like say, for example, we had this deemed export benefit. Deemed export benefit allowed me to kind of procure goods without payment of GST. So it's a cash flow benefit. If I'm not, if I'm an EOU, I'm entitled to kind of procure under deemed exports purchases without payment of GST. But a DTA unit cannot do so. So they'll have to first pay tax and then claim refund. So there's a cash flow issue. So leaving the cash flow issue, but the incidence from a tax perspective, whether I'm an EOU or non-EOU, are same. So more and more units are actually coming out of the EOU scheme only because it is more, compliance oriented, more aggressive, and largely from a cash benefits are also not as competitive as it was previously. So the cost of compliance of an EOU, I have to pay every year certain fees to the EOU authorities and STP authorities, which may not in many times equate to the benefits which I may have availed. So therefore, many companies look at operating as a DTA unit and then avail all those concessions. And if they are not able to avail this one, at least from a input service tax refunds, at least they are able to kind of nullify. So I would say that comparatively, if I were to kind of bring in, EOU has certain set of benefits which over a period of time are getting reduced. And it is possible that over a period of time, the government may abolish this altogether. But yes, whether from a choice perspective, I have a choice to export as a DTA, I have a choice to export as an EOU, and I have a choice to locate myself in an SEZ and export from SEZ. If I'm an SEZ unit, all my purchases, input services can be zero rated because they are treated as exports, right? So I have a cash flow advantage. If I'm an EOU, I can get the deemed export benefits so long as goods which I'm sourcing are manufactured in India. So to the extent goods are manufactured in India and supplied to EOU, the EOU can avail deemed export benefits. That is, whatever taxes are charged can be claimed refund either by the supplier or by the unit. And if I'm a DTA, I pay whatever taxes on purchases, take credit, and when I'm exporting, I claim refund of input and input services, but not capital goods. Right. So one would have to look at the cash flow advantage in a EOU environment, and if it is lucrative enough, then continue. Otherwise, the necessity may not be there. Have I clarified, Kritika?
Yes, sir.
Right. Right. So to summarize this issue with respect to export, with respect to export rebate, largely the way in which the notification is worded, it has created a lot of ambiguity. So the summary of the notification says that if I'm an exporter who has availed certain benefits, then I don't have a choice to pay tax on exports. So the person who's wanting to pay tax on exports will have to look at those conditions. And if they are not availed by the exporter, then definitely he can pay tax on exports. And then definitely the taxes on input services and capital goods are available to be utilized for the tax payable on exports. And whatever tax is charged on those exports are available to be refunded, which is called as export rebate. I move on to the next one, yeah. I have 10 minutes and I hope that in the next 10 minutes, I should hopefully be able to kind of cover these two topics, and at the same time, we also be kind of clarifying a couple of issues or questions which we have. The next issue is with respect to testing vis-a-vis exports. Now, we know that section 13.3 of the IGST law provides the place of supply. And if the place of supply is outside India, basis the location of recipient, then the transaction is treated as exports. In the context of testing, right, it's an activity which is performed on goods. Now, section 13.3 reads as when when services are actually performed in case of goods temporarily imported into India for repair or any other treatment or process and exported without being put to use in India, then the place of supply shall be the location of recipient. Now the question is, if I were to do testing as a service, there are many companies who do testing as a service. Goods are imported, I perform the test function, the functionality test, and I may or may not export the goods which are imported. If I don't export the goods which are imported, necessarily it does not fall within this exception, and the transaction will become taxable even if I earn revenue in foreign exchange. Now, the question is whether the testing would form within the meaning of any other treatment or process. Now, this came in consequent to the 28 GST Council meeting. They said that the word any other treatment or process was added, earlier it was only repairs, was added to promote job work in India. And job work is widely defined. Job work, we know, getting something, doing a process or a treatment on them and sending it back. Now the question is whether testing would fall within the meaning of treatment and process. While we can keep deliberating, I think my view is that testing has to be looked as a standalone activity and should not fall within the meaning of other treatment or process. If I do other treatment or process and also test, then yes, I fall within the meaning and I can kind of treat that activity as exports. But if I do only standalone testing, let's say I am a software developer, I get an equipment, whatever software has been developed outside India, I put it onto that equipment, test the functionality, is it performing properly? I give my results and I export this back. That testing activity I have is not putting as any other treatment or process, right? Because the term repair or any other treatment or process, in the, and including what has been discussed in the GST Council meeting, is to kind of promote job work. So job work, yes, if I was involved in the developmental activity or was involved in the part of, in some manner with that apart from testing, then yes, that particular transaction ought to be as exempt as export, zero rated as export. But in this case, mere testing, if I were to do mere testing, standalone testing, in my view, would have the risk that export consideration which I earn from the person outside India has the risk of, from the basis the place of supply, has the risk of being regarded as taxable supply. So which is what I wanted to kind of bring about through this particular point here. Apart from this, there are certain procedural aspects which I have listed out as practical challenges. Now we know that whenever I'm exporting goods, the FOB value of goods is basis the exchange rate on the date of exports. But my book rate may be different from the FOB value, the shipping bill, which is there for exports. What is to be declared in GSTR1 is the FOB value in the shipping bill and not what is recorded in books. Many times assessees declare what is there in terms of value in books and not what is there in shipping bill. Similarly, one of the conditions as regards consideration is that it should be realized within defined period of time. And wherever it is not realizable within defined period of time, I need to take the approval of the, I mean, there's a procedure prescribed. I need to take the approval from the jurisdictional commissioner for extension and also with RBI, wherever it is exports, for realizing beyond the defined period of time. If it is export of goods, earlier 1 year, now 9 months, is a condition for realization. But the definition of exports of goods and export of services is different in the GST law. The condition as regards realization is only for export of services in GST, but not for goods. For goods, it is actual exports. So the dispute which arises is there is a possibility that I may export goods for value. For whatever reason, I don't realize consideration. In which case, would the supply become taxable? Yes, the way in which, I mean, from the letter of undertaking perspective, one of the conditions in the letter of undertaking is realization within the RBI permitted time and exports of goods within the defined time, which is 90 days. Therefore, my view is, yes, we'll have to, while the condition of realization is not there for exports, we'll have to read the law holistically and probably build in that, see, if you have exported and not realized, you have not probably exported, it should be regarded as if you have not exported only. And therefore, the benefits that particular transaction may be considered as liable to tax. So that's how. And let's assume that the consideration is realized beyond a period. There's a specific mention in the statute to say that whenever it is realized beyond one period, at that moment it would be treated as zero rated, and the tax whatever has been paid can be claimed as refund. But the assessee would anyways be liable to kind of pay interest. So that's how it is. The next is with respect to turnover of zero rated. This is a recent condition which kind of came in, where the one of the conditions says that to kind of cap the value of exports, it is not only the transaction value, but 1.5% of the FOB value of like goods which are domestically supplied. So if I have goods which are domestically supplied and exported, the 1.5 times of the value of domestic supplies is the maximum value which has to be considered for exports. So the condition says that it is export value or 1.5 times of the FOB value, whichever is less. So if my export value technically is say 2 times of domestic value, that 2 times is disregarded and 1.5 times of domestic value is what is considered. Now there could be various issues connected with this. One is that I may not have identical transaction of what I export into domestic market. Then what do I do? Right? Similarly, there could be differential periods within which I may have kind of supplied in domestic market. So do I kind of consider basis quantitative similarity or basis last in first out types that way? So there are issues connected. We may have to kind of wait and see how this kind of devolves upon. But yes, we'll have to look at this case by case. Similarly, there could be transactions where I do a bill to SEZ but ship to outside SEZ. Just because it is billed to SEZ does not mean that it becomes zero rated, right? It has to be also received by the SEZ unit for the authorized operation. If it is not received by the SEZ unit for authorized operation, that particular supply is a taxable supply. The SEZ unit, the supplier supplying in this case will have to charge tax. The SEZ unit can claim credit, and depending on the nature of transaction, it will be able to kind of utilize the taxes for the subsequent supply. And on the execution of LUT, I have already addressed that yes, it can be executed at any point of time. But the issue which devolves on is if I have executed LUT, is it necessary that all my exports have to be without payment of tax, or is there a possibility that one or few of such exports I have the option to pay tax on exports? In our view, execution of LUT, yes, it gives you the power to export without tax. At the same time, it does not debar you if you are entitled to pay tax on exports. So you could select a few transactions and choose those few transactions to be under rebate, that means pay tax, and few other transactions to be at zero rate. That's my personal view. So largely, what have I done? I have discussed with you on the meaning of exempt transactions, that is exempt supply, non-taxable supply, and transactions which are deemed by the legislature as not being a supply of goods or services. I've discussed with you the meaning under the GST law on what is zero-rated supplies. I've discussed with you on issues connected with exempt and zero-rated supplies. I have tried to kind of the way in which I have illustrated those issues. I have tried to kind of cover all major issues surrounding certain topics, just to illustrate that what all could kind of be asked or could have implications under the GST law with this topic. Yeah. So I hope I have kind of given justice to the topic. I'll now leave it open for any questions, and once the questions to the extent are considered, I'll try and kind of resolve, and wherever I'm unable to, I'll be happy to kind of address it through a subsequent kind of email to the branch, which can kind of send it to you. So I'm now open to any questions on the topics which we have for today's discussion.
Yes, sir. Thank you, sir. Thank you for your detailed explanation on exemption and also the practical cases which was taken for the exemption purpose, sir. There are a few questions, sir.
Yeah,
First
please.
question is, one of the claims missed to avail the refund within due date. Were there any possibility to avail it now? The transaction took place during the financial year 2018-19.
One second, the volume is a little more. Let me kind of, yeah, please tell me.
Yeah, one of the claims missed to avail the refund within the due date. Whether any possibility to avail it now? The transaction done for the financial year 2018-19.
Yeah, so the statute says that I can claim refund in terms of section 54 within 2 years from the date or the month in which I have exported. If 2 years have lapsed, unfortunately, consequent to the limitation, I cannot do. When if you were to see section 54, it empowers refund in two scenarios. One is for exports, the other is for inverted duty. For supplies to SEZ unit, which is treated as zero-rated supply, for the financial year 17-18, the provision read as 2 years from the end of financial year and not 2 years from the end of month. So if it is a transaction connected with 17-18, you could take as end of financial year for supplies to SEZ. But for exports and other zero-rated supplies or inverted duty, we had to kind of consider 2 months from the date or the month of exports. And now for the period 18-19, it is 2 months from the date of exports. So if it is exported in the month of April 18, unfortunately March 20 was the due date. If you have not claimed, practically consequent to limitation, we will not be able to claim refund there. We can carry forward the credit, utilize it for any other liability, but government may not give you refund for the transaction.
The second query is regarding LUT. Once it applied online, the GST authority are not approving it. How to proceed with this situation? Can I export the service at zero rate and then can be applied?
Wonderful, yeah. See, once you have submitted online, it practically now does not require acceptance by government. Once you have submitted online, it is enough. Earlier, for the first year, right, I had to print it out, go it to the jurisdictional office and get it accepted. But in the current scheme of law, the fact that I have submitted online, it is sufficient compliance.
We don't have to wait for till the approval, sir?
Not required. So the fact that you have done your duty, of having it successfully submitted, that is enough. And as I said, there's a, in fact, the way in which we have seen, you could export without LUT, and after, but within the same financial year, still execute it.
Okay.
So we consider, in our view, we consider this to be a procedural condition and not a substantive condition.
Okay.
So execution of LUT should be regarded as just procedural and not substantive condition for exports. The section is very clear for what is export. It doesn't, I mean, from a rules perspective, they say that yes, you need to kind of execute an LUT. Section does not bring out execution of LUT. Because rules bring out, we believe it is procedural. Had the section said for exports you had to execute an LUT, then yes, it would have been a substantive condition.
Okay, sir. From the perspective of club, what are the surveys which are exempted?
In the context of club, what is exempt? So, yeah. So see the jumbo notification for association of members, the fee which is 7,500 rupees for the benefit of those members, which was earlier 5,000, is the alone exemption. All supplies which the club does, which is supply of say goods or services, whether to members or otherwise, right, for a particular value, those supplies are taxable supplies. And the threshold exemption, which is like 20 lakhs in a year, is the other threshold which the clubs can. So if my total taxable turnover is less than 20 lakhs, and then any supply, whether goods or services which I do, I don't have to kind of be registered. Or if I'm collecting some amount from the members, if the amount which I'm collecting is less than 7,500 rupees per member for the benefit of members, there again, I don't have to kind of pay tax, provided, even if in one case or more, if the amount crosses more than 7,500, it may have, I mean, from a registration perspective, it may have, if it crosses the threshold, the requirement to register. Any other questions?
Previous question which was not answered by you. Can we pay tax for export using ITC on capital goods and get the refund of the tax?
Yes, the answer is yes. As I said, first is we have to see, am I eligible to pay tax on exports? The slide which I have brought out the issues, it highlighted that as an exporter, you will have to check whether you are availing certain benefits. If you are availing those benefits, you are debarred from paying tax on exports. Assuming you have not availed those benefits, then you can pay tax on exports. Once you pay tax on exports, then input services and capital goods can be used to pay tax on those exports, and then refund of the tax paid on exports can be claimed. So that's export rebate. So to answer it, capital goods credit, if the exporter is allowed to pay tax on exports, is eligible to be utilized for paying the tax on exports. Does that clarify?
Yes, sir.
Any other questions, Kritika?
So till now there are no more questions, sir. Ask the members, if anybody wants to raise the question, they can unmute themselves and ask the questions.
Fine, Kritika, I think others are not having, so maybe we can kind of conclude the session.
Yes, sir.
So before this one, let me kind of thank the audience here. It was really privileged for me to kind of participate with the three branches and share my views on this topic. I hope I was able to kind of give justice to the topic. I sincerely appreciate the patience which each of the members have shown during this. Thank you so much for this opportunity. It was sincere my pleasure to be part of this webinar.
Thank you, sir. Now I request Vellore branch treasurer sir to propose his vote of thanks.
Good evening, friends. Is it audible?
Yes, sir.
Yes.
Thanks our CA, Mr. Deepak Kumar Jain, sir, for wonderful presentation about the exemptions and zero-rated supplies in GST. I think this is one of the elaborate presentation, and most of the members got benefited by this detailed presentation. Thanks for your wonderful presentation. And also extend my heartfelt thanks to Chairman of Vellore, Salem, and Pondicherry chapters for arranging this wonderful seminar. Thanks one and all. Thank you.
Thank you so much. All of you have a wonderful evening.
Thank you, Deepak sir. It was
Okay, thank you,
excellent,
sir.
excellent
Thank you, Deepak, sir.
presentation.
Thank you. Thank you.
Thank you.